Hey there, everyone. Welcome to Chart This with Dave Keller. It's Friday, January 17th. Thanks so much for joining me here today from a beautifully overcast and kind of cool and wet Redmond, Washington. Appreciate you joining me every weekday after the close. On Friday, we like to do a special all-mailbag edition, and that is what we are doing here today. We receive a lot of great questions during our live streams when we stream on YouTube, Facebook, LinkedIn, and X. And I appreciate those of you that are tuning in live and asking questions as we go. It makes it a really fun time spent together, and it really gives me some interesting ideas about what sort of content to share with all of you. So I can't tell you how much I appreciate you guys asking questions during the show. Also appreciate you guys watching the replay on our YouTube channel and putting questions in the comment section there. Really appreciate those. And I take some of the great questions we received during the course of the week. I like to do an all mailbag episode and share some of the answers when we have a little more time to do it. I usually take a question or two at the end of each recap, but this gives us a little more time and space to do so. As we're recording this episode, we're actually recording it a little earlier in the day on Friday the 17th, so it's sort of around lunchtime Eastern. Can't help but notice the S&P indeed pushing above trendline resistance, and this move so far taking the S&P above 6,000. Clearly eclipsing that pink line, which is sort of our kind of stop to the bearish scenario that we've been talking about. Getting back above that trend line, suggests a return to a confirmed bullish phase. So we'll see how the rest of the day plays out. We'll see what the end of this week means for our market trend model. We'll see what happens with a lot of stocks pushing higher today. The NASDAQ 100 potentially breaking out of a bull flag pattern. So we will be digging into all of those patterns for my Market Misbehavior Premium members. You'll be getting a weekly flight plan video and discussion over the weekend where we really dig into, that's our core report, where we dig into some of these topics and think about positioning and expectations for the week to come. So if you like what we're doing on the show and want to get a little more information about some of the more, specific ways that we're thinking about market conditions, check out our premium memberships. I'll have a little more about that a little later in today's episode. But hey, let's get to the first question. And again, thanks. These all come from viewers like you through the course of this week. Question one, Dave, can you explain why sometimes you use the PPO indicator, then other times I see you use the RSI? Really appreciate that question. And you're right. I mean, my sort of standard chart, if I'm bringing up a chart like Home Depot, involves the 2-year time frame. I have the daily bar chart. I have the 50 and 200-day moving averages. I have the RSI indicator, and then I have relative performance, right? So these bottom two are the most important indicators that I follow, and here's why. RSI is a measure of momentum. If you're analyzing price action, which is what I do primarily, I literally start from top to bottom. And you start out by analyzing price, what patterns, what levels, what trends, moving averages, all of those sort of things help you understand the trajectory of the price trend over time. But then below there, we have the RSI, which is a measure of price momentum. Looking at the movements in the stock day to day, the momentum actually measures the way that stocks are actually moving in their trends, right? So, what an indicator like RSI is doing is it basically measures positive momentum versus negative momentum. It does that by looking at the up closes and the down closes, and looking at the relative performance of those two types of days, and with the idea that you can get a sense of when the market's gone too high too quickly or too low too quickly, or as we say, overbought and oversold. And so price momentum is important. I find that's a great way to add to the insights you're able to glean by looking at the price action itself. At the very bottom on this chart is relative performance, which looks at the way that this particular stock or ETF is performing relative to the benchmark. And this is absolutely valuable because you want to, generally speaking, own things that are outperforming the benchmark. Otherwise, why not just, close your eyes, plug your nose, buy the S&P and go off on the beach somewhere? So if you're really going to active manage your portfolio, you need to own things that are doing better than average. And so owning things where the relative strength line is turning up is pretty powerful. Now, the other indicator that I do mention occasionally, it's not on my main chart, but I often add it on, is an indicator called PPO. It's called the percent price oscillator. Now, this is derived from another indicator designed first called the MACD, the moving average convergence divergence. That indicator basically uses exponential moving averages of the price data and looks at how those averages are widening out or getting narrowed together when they cross over one another as well. And so that indicator is basically based on exponential moving averages of the price. And you look for when they cross up or cross down as a signal that the trends are shifting higher or lower. And as you look at the chart of Home Depot here, and I'll zoom into like the last year, we can see basically this is a classic sell signal where the PPO line crosses down through the signal line. This is a classic buy signal where it crosses up through the signal line. Most recently, Home Depot in the last week has generated a buy signal, signaling that the trend is reversed higher. A lot of individual stocks through the course of this week are generating similar buy signals, by the way. So the PPO indicator is more of a trend following indicator, right? And I think the recent action in Home Depot kind of shows why I like to use the two of these together. So the RSI, basically when the RSI becomes oversold, that tells you the price has gone down a lot. That tells you to start looking for signs of a tradable low. Now, the other thing to note here would be what's called the bullish momentum divergence, which is the price going lower and the RSI sloping higher. So right about here, you're getting a signal that even though we're making a lower low, it's on less negative momentum. That actually could be an encouraging sign. So the RSI becomes oversold. You get these bullish divergences really before the bottom's probably completed. This is kind of a during the bottoming process kind of indicator. So I think of RSI like a leading indicator. But how can we confirm that that thing that just happened recently was a low? That's where we use trend following indicators like MACD or PPO. So that actually doesn't give a buy signal until here when you're actually trading higher. It probably really didn't complete that crossover until the gap higher. So, it's sort of a lagging indicator. It's not meant to anticipate a bottom, but confirm that a bottom just happened. Similar sort of thing at tops where you'll see a price go higher. You'll see the RSI start to slope lower, which says we may be getting near a peak. And then all of a sudden you often get sell signals. In this case, the sell signal actually happened earlier than normal, kind of in the middle of that move. But often this will signal a little later. So by combining some leading indicators like RSI, like here at the low in April, giving a potential bottoming signal, and then combining that with the, buy signal from the MACD or the PPO, which is more of a lagging indicator, I found combined different indicators with different styles can be really helpful because one is anticipating a move, one is confirming a move. By using the two of those together, you get a pretty good overall picture of trend and momentum shift. So that's why I kind of use them. I highlight them individually when I think there's a great example of an individual stock that I think is important to highlight. In my own trading and my own investment process, I would use a series of these indicators as a checklist. Think about what they're telling me overall all about the conditions, and then think about whether I want to put money at risk playing that potential reversal. So that's why I use those two particular indicators, and that's why I use them kind of interchangeably. It depends on what's signaling at what particular time. Great question, by the way. I hope that that helped clarify. Next question. I've heard it said that you should never place a market order, only limit or stop losses. Your thoughts? Well, you didn't hear that from me for sure, because I rarely use limit or stop limit orders. I do use stop losses, but I use market orders primarily. And I would say that's more a question of time frame. I don't have a problem with using market orders because if you're not that worried about slippage in execution, if you're betting for the next couple months, the particular price point at which I'm executed in the next 3 minutes, I shouldn't be caring that much about that. Otherwise, I'm getting drawn into a very short-term time frame, which, my goal is to make money over a period of weeks and months, not to sort of, nickel and dime a particular execution point. So when I think the chart tells me to buy, I put a market order for that position almost all the time. Limit orders can be valuable if you have a shorter term time frame. If you're a swing trader, I would definitely be using more limit orders because then you are locking into a particular price level. If a particular limit is reached, if a level is reached, then take this action. And as a longer term investor, you don't need to be watching moment to moment trading. You shouldn't, right? You should be focusing more on long term trends and just place orders and assume that they're going to be filled at a decent level. If you're trading more actively, if you're trying to fill a trade in a particular window of time or at a particular price level, then you really need to start using limit orders and stop limit orders to really fine tune your entry and exit points. I have found individual investors a lot of times spend too much time trying to optimize, little movements in the price as opposed to just focusing on the bigger thing. I mean, I think for a lot of investors, just recognizing the trends, allocating to stocks that are outperforming. That's less about optimizing this minute to the next and more about recognizing trends and being on the right side of market conditions. I think that is a much more important question for a lot of investors to ask. But if you're day trading, if you're swing trading, anything in that kind of shorter term time frame, limit orders are valuable because, and maybe that's what this particular person was talking about, because you're trying to really, I have a more idealized entry and exit point. And by using limit orders, you're ensuring that a particular market move has happened before you're triggered, and you can set those way ahead of time, right? So you put an order out, and then if the conditions fulfill that, then the order's filled. For me, I'm just trying to make a trade, and I want to get pretty good execution. I would say, as much as people worry about execution from the brokers, I don't see that as a huge issue. I think it tends to be overblown. Now, stop loss is very different, right? Stop losses, I think, are incredibly important. Two general ways I think you can use stop losses. Number one would be, you place a trade, you immediately enter a stop order. So if XYZ happens, a trailing stop, if XYZ happens, sell, or put in a level, and as your position keeps working, you bump your stop higher. I don't tend to do that, although if that is what's going to help you stay true to your game plan, you should do it. For me, I just set alerts. I set alerts when something is going to happen. When it does, I reevaluate the chart and then take the make the trade. Again, these are luxuries I have thinking a little more longer term. If I was a swing trader or shorter time frame, I'd probably be using those automated tools a little more, because I don't have the ability to watch a bunch of charts and watch the flickering ticks moment to moment. So by putting in that framework, using those orders and just updating the orders as the market changes, that's probably a better way to do it on that time frame. So it was a long-winded answer to say it depends. It depends on what kind of game you're trying to play. For what I do, I don't see it as important as probably others most likely do. Next question: will small caps come back if the market slows and or cuts increase? I'm assuming you're talking about interest rate cuts from the Fed. Trying to decide whether to bail at a loss. Yeah, really good question, and that's a question that came earlier this week. So looking at small caps, I think I actually had a chart picked. Did I? No, that was earlier this week. Okay, let me go here. Equity market indexes. Russell 2000 ETF. Yeah, so you kind of asked this question during this little, period down here, and are small caps going to come back? So I actually wrote an article earlier this week on stockcharts.com, and I'll share it with you. It's a free article. If you go to stockcharts.com, go to articles, you'll see this a couple of days ago. What would it take for small caps to lead? So I point you there. I'd encourage you to check that out. It's free to access and could be an interesting summary of some of the conditions that I would look for. But I'll walk through them with you. I would say, so there's a difference between the conditions that could allow small caps to thrive, and I think we are certainly seeing some of those. And the two that immediately come to mind would be, number one, strong dollar, right? The U.S. dollar is super important when you're thinking about small caps. The reason why the dollar is so important is because a strong U.S. dollar can really start to weigh on mega cap companies' earnings, because big multinational companies make a bunch of money outside the U.S., and then they have to convert those non-U.S. revenues back to dollars. So if the dollar is very weak, all that money you're making outside the U.S. just converts into way more dollars, and as a result, your revenues are more. If the opposite happens, which is what we've experienced since late September, the dollar has been rallying from the beginning of Q4 really through so far the beginning of the first quarter of the new year. And that stronger dollar means the opposite. It means if you're making a bunch of money outside the U.S. and you convert it back to dollars, your non-U.S. earnings are worth less U.S. dollars. So as a result, your revenues are reported lower. So a strong U.S. dollar will be a problem, or can be a problem. It can certainly be a headwind for big multinational companies that have a lot of non-U.S. revenue. Small cap companies, smaller companies based in the U.S. probably don't have a lot of operations outside the U.S. And as a result, they don't have that currency effect to deal with. So a strong U.S. dollar isn't necessarily beneficial for smaller companies, but it's not good for bigger companies. And as a result, on a relative basis, smaller companies can do better because they don't have that issue. And so the dollar continuing to strengthen could very well be a great environment for small caps. Doesn't guarantee they're going to go up, but it's definitely a factor to think about. The other thing I would say would be in terms of leadership, right? And if you look at growth versus value, right? If you're owning small caps, you're basically assuming that this ratio, which has certainly been favoring growth over the last couple of years, this ratio starts to turn lower. Here on the top, we're looking at the relative performance of the large cap growth versus value indexes. It's rotated lower. So in the last 4 weeks, value has actually been outperforming growth. And you've seen that with sectors like industrials, financials, even like materials starting to improve on a relative basis. And that speaks to the fact that there's been at least some rotation away from growth leadership like semiconductors and software companies into value sectors, value names, banks, other financials, industrials, construction names. Again, over the last month, we've started to see a bit of that rotation. So if that continues, the mega cap, the indexes like the S&P and the NASDAQ are big weighted into growth sectors. The small cap Russell 2000 index is more weighted to value sectors. So the two biggest sectors, biggest sectors for the Russell 2000 are industrials, financials, and healthcare. So more value sectors, right? So if value starts to outperform, that again doesn't guarantee that small caps are going to outperform, but it would imply that small caps probably are better suited in that environment because they're just bigger weights in those sectors that are starting to do well. So I would say there's some macro trends that certainly seem to be favoring small caps, but with that in mind, you're really still not seeing small caps outperform in any meaningful way. This is the IWM, which is the Russell 2000 ETF. It's worth noting, like I highlighted those bullish divergences on some of the previous charts. You're seeing a bullish on the Home Depot chart, seeing a bullish momentum divergence right now on small caps as they test the 200-day moving average. You're seeing a bit of a bounce. But again, everything's bouncing right now, so you're still not outperforming much with small caps. So from a technical perspective, small caps gave back a lot more in the last 6 to 8 weeks off of a late November peak down to the 200-day, while the S&P and the NASDAQ were kind of between the 50 and 200-day moving average, and the S&P kind of getting back above the 50-day moving average. The Russell 2000 is actually testing its 200-day moving average, which is much, much lower, obviously. So I would say small caps have been underperforming. What encourages me about small caps is that the conditions that small caps should do well with are starting to manifest, right? Meaning an improvement in the relative performance of value sectors and strengthening of the US dollar. Having said that, the proof is in the price. And I would say we're not really seeing enough of an upside move or an upside follow through in the Russell 2000, particularly in the relative strength, to make it seem like it's a good relative bet. On absolute terms, holding the 200-day is vital. And for now, we're seeing encouraging signs as it tests that 200-day. I would say for now, it appears to be kind of encouraging here going into the weekend. Great question, by the way. And again, I encourage you to look at that article, a little more detail on some of those charts that I just mentioned. But and I did a YouTube video, which you can find through that article, which goes through some of that as well. I do want to take a moment again. If you follow my work here on the show, Chart This. If you follow my podcast called Market Misbehavior, there's more that I can offer you to hopefully help you improve your decision making. My goal and my experience in the industry has been working with big money managers and institutional investors, helping them get better returns by using charts and technical analysis. My career has evolved to work more with individual investors and financial advisors to help them use some of the tools and techniques that we used in the institutional community. And I found it a very rewarding experience to get to know some of my premium members, to help them improve their decision making, to help them see that they can actually manage their money effectively by applying some of these principles of technical analysis and behavioral finance. So I would say, if that is of interest to you, I would encourage you to check out our Market Misbehavior premium memberships. Make sure you use the code YouTube when you check out for a special deal, a discounted rate for your first 12 months. I would encourage you to check it out. Basically, 3 parts to that premium membership. Number 1, a bunch of virtual courses, which are all available on demand on technical analysis, behavioral biases, different indicators, and how to use them. We're adding more and more virtual courses here in 2025, and a lot, hopefully, to help you improve your understanding of this powerful toolkit that we talk about every trading day on the show. Second piece would be a members-only community, an interactive space where some of my other premium members, as well as myself, come in to answer questions. It's a place where you can share thoughts, share frustrations, ask questions, and get some hopefully knowledgeable people like myself and others to answer questions. Get a lot of questions on a lot of topics, but it gives you direct access to me and some others to help you make sense of things. And then the third piece about that would be our premium members only reports, like our weekly flight plan, as I mentioned at the beginning of today's episode, which we put out every weekend. It's our core report where we look at the week that just happened. What did we learn? We look forward at the week to come, and what levels and patterns we're looking for. If you think about what we do on this show, which is a daily market recap, that's really incrementally adding to the main work that we did over the weekend, which is called our weekly flight plan. We also do a monthly chart review, a high level look using our proprietary market trend model and applying it to a bunch of different charts, looking at performance trends and thematic shifts and all of those things month over month that I think can help you understand how market conditions are evolving. If you want more information, go to marketmisbehavior.com/premium. Again, make sure you use the code YouTube when you check out for a special deal on your first 12 months on any plan. Getting to probably two more questions here, then we'll wrap it for the week. Question 4, if and when a new bear market occurs, would you advise sitting out, no trading, or trading short? So number one, I would not advise or recommend anything. As you see, hopefully from the disclaimers that I put on my show, everything I share with you here is for educational purposes only. It's meant to help you improve your understanding and help you make better decisions. It's not to tell you what to do. So I am not advising or recommending you do anything with this information without first consulting a financial professional. However, what would I do in that sort of environment? So, I would say, a couple things. Number one, a lot of investors use the market trend as a main indicator. And I certainly pay very close attention to it, as you probably get from the show, because we look at this chart of the S&P 500 every trading day, right? And think about what the new day's information does and what it tells us about how the trends are changing. I think we're at a pivotal moment here in January with a lot of noise, with potential breakdowns, potential breakouts. So I'll look forward to continuing to track these markets and do my best to help you understand what these the most latest moves mean for you and what they could mean for your portfolios. If we would get sort of a more protracted bear market phase, I would say two things. Number one, the general trend in the market for me tells me how much I want to be allocating to new ideas or how much I want to be focusing on lightening up, right? Do I want to be putting cash to work by owning risk assets, or do I want to be raising cash or taking cash out of the markets and cushioning myself from market downside? And when the market trends are positive, I want to be putting as much money to risk as I can. And when market conditions are negative, I want to be taking bets off the table. However, I will tell you, having gone through a number of bear markets in my career, there are always things that still kind of look just fine, even though the market trend is negative. And you've seen that. We look for stocks that were up in 2022. They were out there, right? There were stocks making higher highs and higher lows. So I would say for me, the market trend being negative doesn't tell me to just start selling and be selling risky, selling equity positions just because the trend is down. If the chart of a stock is still going up, I'm going to want to own that and follow that trend as long as possible. So I am not a fan of just selling blindly because the conditions overall are negative. Does that mean I want to be less aggressive about taking new positions? 100% yes. And so, I would think of the market trend as more permission to buy, right? So if the market trend is positive, you have permission to buy new ideas. If the market conditions are negative, you do not have permission to buy. So don't be looking for new ideas. Just be looking to manage risk and taking bets off the table if the charts that you're looking at require it. Now, there are others that will tell you it's more of a market call. And if the market's bullish, buy a bunch of things. And if the market's bearish, don't buy things. Again, I think I spent too many years working with Peter Lynch style investors, including Peter himself, but a lot of his mentees that were managing money when I was at Fidelity and other institutions that I've worked with. They were stock pickers. So it didn't matter to them what the market was doing. They would want to own good companies as long as they could. And as long as the charts still supported that, they still want to own that. And I think that way of thinking really impacted me, because I saw how they were able to, at times do well when market conditions were bad, because they owned companies that were still doing well. What you don't want to do is own stocks that are doing poorly. And that is what you want to absolutely avoid. All right, final question here for the day and for the week. Do you change the RSI values depending on the market? You actually had a larger question. I kind of summarized your question as that, but you mentioned like in a very volatile market, you might raise the overbought level to 80 or 90 so you stay in trades longer. In a calmer market, you could lower the oversold level to 20 or 10 to spot potential reversals sooner. So I really appreciate the essence of your question, which is, should I adjust the RSI levels based on market conditions? And the short answer is no. And here's why. And again, there are different things we're thinking about. I mean, one thing I do talk about is how the range, it's, overbought is not 70 and oversold is not 30 all the time. I would say in a bullish phase, that whole range can pop up, and maybe 80 is the new overbought and 40 is the new oversold. And in a downtrend, maybe 60 is the overbought and 20 is the oversold. That I would agree with. But do you adjust RSI values based on market conditions? And the answer is no, because one of the cool things about the indicator that Wells Wilder designed, about 50 some years ago, is the fact that it's dynamic based on that particular chart. So an RSI of 70 means something for a stock like IBM. It means something different for a very volatile biotech company. It means something different for a large cap utility company with very low volatility. The RSI, it's not like a low volatility name like a utility stock has a very narrow RSI, and then a big volatile name like a biotech has a huge RSI. It's standardized based on the price action because it's based on the average up day and the average down day for that particular asset. So a stock that's noisier, that has bigger swings, the RSI kind of adapts for that automatically because it's telling you when is this move unusual for this particular stock or ETF. So RSI already has a built-in kind of dynamic lever or dynamic adjustments that are done based on the volatility and the price action of the particular asset. I would tell you, if you're finding that you're not getting the signals that you want to have, instead of bumping out the overbought and oversold levels, I would look at a smaller period. So instead of a 14-day RSI, maybe do a 9-day RSI, and I'll show you the difference, right? So here on the same chart, there's the 14-day RSI. Here's the 9-day RSI. Same indicator, but the 9-day RSI, obviously noisy, right? It's more because it's looking at a shorter period of time. It has a lower smoothing adjustment. And so it's just going to be more sensitive. So if you're finding you're not getting enough signals, look at a shorter time frame. If you're finding you're getting too many signals, make it a 21-day RSI and look at a larger time frame. That's how I would adjust the indicator. Don't think of adjusting overbought, oversold levels, particularly widening them out. I don't think that's going to help you a whole lot. Look at make the indicator more or less sensitive. That's the way that a technical analyst would answer the question that you have posed. Folks, that's it for this week. And thanks so much for sending in those great questions. Again, those questions came from viewers like you over the last week or so. I've got some other great questions. The mailbag we'll hopefully get to next week, but we can always use more. So if there's something that is top of mind for you as you're trying to navigate these markets, please let me know. I appreciate so much those of you watching these episodes live, those of you watching on replay. I've really enjoyed putting this show together. Hopefully you can pick up on the fact that I enjoy doing this a great deal. I really enjoy educating investors, helping them make sense of the markets. I can't tell you I'm going to be right all the time. I can tell you it is in my goal and it is in my best interest to give you the tools you need to make better decisions. And I hope we can do that together. And I look forward to doing that through the remainder of 2025 and beyond. For Market Misbehavior, I'm Dave Keller. Have a fantastic weekend. We'll see you next week. And until then, remember, it's always a good time to own good charts. Take care, folks.